Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video we are looking at the Vanguard Materials ETF. This ETF obviously has a loads of non-Sharia compliant stocks, so we are looking only 5 companies in there that are in the top 10 that could potentially be a great addition to our portfolios. What I've started recently is to look at the S&P 500 sectors and pick 5 companies from each sector that we could potentially add to our portfolios. If you're thinking of investing in the stock market and you are new to the channel and so on, obviously subscribe to the channel, like the videos. But what I'm trying to do here is to kind of give you an idea of some of the companies that are in each sector to actually invest in, right? And then you're going to go away and do your own research and make sure these companies are well suited to your portfolios and so on. So you're going to have to do that research on your own. But the idea is that I'm giving you some ideas of where to start, and then you go away and do your own research. S&P 500 is basically the 500 biggest companies in the US, and each sector will pick the 5, either top 5 or within the top 10, pick the five companies that Sharia compliant. That will definitely help us to basically diversify our portfolios. It's really important to diversify your portfolios, because in a situation where one of these companies goes down, at least you've got loads of different other companies. You can also diversify by sector, by stock, by and so on. So in today's video, I'm gonna, as you can see, I've got 30 different companies in this portfolio. So I do feel like it's actually diversified enough. But at the same time, my target has always been between 30 and 40, or 35 to 40ish if you like. So I will be adding a couple of more stocks, but obviously right now everything seems a little bit expensive, apart from some of the technology companies which I will be looking at very recently, especially in the technology companies, right? So anyway, let's get started on the video. I want to show you 5 companies from this ETF that you could potentially add to your portfolio. Again, if you like this type of content, please like the videos. It really genuinely helps the channel. So please go ahead and do that now if you haven't subscribed to the channel, and also basically definitely subscribe to the channel. Right, so the first thing we're looking at is basically the same usual: company, market cap, moat, price, dividend yield, latest dividend yield, 5-year growth rate, payout ratio, how long that they've increased the dividend, the safety of that dividend, profit margin. We're looking at return on equity, free cash flow. We're looking at total return in the last 10 years. We're looking for basically next year growth in terms of growth, earnings growth. We're looking for next year, how much is basically expected to grow, and then next 5 years. So I want to see if this company is growing, how much this company is growing next year, and then the next 5 years. Okay, Morningstar valuation to tell us basically whether this company is undervalued or overvalued, and then the fair valued. So that is the plan. So let's have a look at the first company, and that is a company called Lin. Lin is basically a global multinational chemical company. It was founded in Germany and recently actually moved to their headquarters in the UK. So right now they're based in the UK, but obviously it was founded in the US, in Germany, sorry. The company offers different types of gases, including oxygen, nitrogen, and rare gases, and also includes carbon dioxide and so on. This is, I think, is the biggest company in the basically when it comes to this sector. Okay, it has a 169 billion market cap. It has a narrow economic moat. It has a price of $344 per share, 1.36 dividend yield. Latest increase was 10%, 5-year growth rate of 7%, which is really good. Payout ratio, we're looking about 38, which is quite low, and then 29 years of increase in that dividend. So they are now a dividend aristocrat. Safety 99%, profit margin 11%, return on equity about 9%. Free cash flow of $6.9 billion, which is very good. Total return in the last 10 years, we're looking at about 13.44%. Next year, they expected the earnings to grow about almost 7%. And the next 5 years, we're expecting about 11%, according to Yahoo Finance analyst, right? Morningstar valuations, we're looking at a fairly valued at the moment, okay? And then $347 per share is where it should be. Right now, it's $344. So it's almost basically fair valued at the moment, okay? And The next company we're looking at Sherwin-Williams. This company sells, manufactures, distributes, and sells paints, coatings, and related products to professional, industrial, commercial, and retail customers. They are competitor when it comes to PPG, which we'll be looking at in a bit. It has a market cap of $64.4 billion. It has a wide economic moat. The current price is $249 per share. Dividend yield of 0.96, almost 1%. Dividend safe. Latest dividend increase was 9%. 5-year growth rate of 14%. Payout ratio 29%. And they have increased this 43 years in a row. Now that's basically dividend aristocrat heading towards dividend king. Safety. So dividend aristocrat, by the way, is the companies that have increased their dividend 25 years in a row. And also kings are 50 years plus. Okay. Safety, we're looking at about 87%, profit margin of almost 9%, return on equity 81%, free cash flow we're looking at just less than $1 billion, total return about 17%, and next year they're expecting 17% growth, and next 5 years 11%. Now that's probably why this company is actually in trading a premium at the moment. 22% premium right now. $205 per share is where it should be, but right now we're looking about $250, so it's a little bit expensive. The next company is a company that I own in my portfolio, very similar to Lean. They also have sell all different types of gases. They have $68 billion market cap. Okay, so it's very small in comparison to Lean. It has a narrow economic moat, $303 per share. Dividend yield of 2%. Latest dividend increase was 8%. 5-year growth rate of 11%. 61% payout ratio, which is basically where we normally look for. Anything above that is a bit too high. Dividend streak of 40 years, so they're definitely dividend aristocrat heading towards being a dividend king. Safety 95%, which is perfect. Profit margin about 18% almost. Return on equity almost is 17%. Free cash flow just $303 million, which definitely covers the dividend. Total return in the last 10 years, we're looking about 15.86%, which is almost a 16%. Next year, they're expecting about almost 10% growth in terms of earnings. And the next 5 years, every year, they're expecting at least 11% on average, right? Morningstar is saying very valued at the moment. $322 per share is basically what they expect the price to be. Right now, as you can see, it's $309 per share. I own this one in my portfolio. I don't own the other two. I'll show you how many shares I own and how much I'm either up or down in a second. Next company is a company, I think one of the subscribers actually asked me to look at this company, so I'm going to look at it in more details. But Scotiva is actually in the agriculture side of things. This company operates two business segments, and it operates through basically seed and crop protection. That's basically what they do. And I think it was a spin-off from another company. I can't remember the name of the company from the top of my head. Not long ago, I think about 4 or 5 years ago. Right now, as you can see, they have $47.4 billion market cap. They have wide economic moat, $66 per share, almost 1% dividend yield, 7% growth in terms of latest dividend increase. 5-year growth rate, they don't have that because they haven't been around for 5 years, right? Payout ratio, we're looking about 23%. And then when it comes to dividend streak, they have increased that dividend for 2 years. Safety 70%, profit margin 8%, return on equity only 5%. Free cash flow, we're looking at about $780 million. Total return in the last 3 years, okay, not 10 years, last 3 years, we're looking at about 37, almost 38% in 3 years. Next year, they're expecting about 21% growth. And then in the next 5 years, they're expecting every single year 17% or more in terms of growth side of things, which is absolutely amazing, and it's fairly valued at the moment. And $70 per share is basically where the price should be, and as you can see, it's $666 right now. This company seems really interesting. If they were not, I would have preferred if they were not paying dividend, probably increase. Maybe it's still in growth side of things. I need to do a little bit more research and find out, so I will be sharing that with you guys very soon, because one of the brothers or sisters have actually asked me to look at this company, so it'll be interesting to find out. But yeah, that's the Next company, the final company we're looking at today, PPG Industrials. This is a company that I own in my portfolio, very similar to Sherwood-Williams. They also have a lot of coatings, a lot of paintings, and so on. $31 billion market cap. It has a narrow economic moat. $133 per share. In terms of dividend yield, I'm not sure what happened there. There you go, looking at 1.86%, 5-year growth rate of 5%. Latest dividend increase was at 5%, and the 5-year growth rate of 8%. Payout ratio 39%, so they have a room to improve that. They have increased this dividend for 50 years, so this company now becomes dividend king. Safety, we're looking about 93%, profit margin 6%, return on equity 17%, free cash flow $313 million, and total return in the last 10 years about 10%. Next year, 17% expected to grow. The earnings are expected to grow about 17%, and the next 5 years about 6% every single year. Morningstar is saying right now is 22% premium. Morningstar always says this company is expensive. Since I started investing, they've been saying that, which I absolutely kind of agree at the moment, but it's gone down almost to $100 per share. So I'm sure if the market basically drops again, it'll probably go back to that again. $109 per share is where they expect, and I think I can agree. I would love to buy more of this company if it goes back down to about $100 per share. So there you have it, 5 different companies. I'm going to quickly show you in terms of Sharia compliance side of things where things are, and as you can see, every single one of these companies has absolutely no problem. It's the only one that I would be worried about is Sherwood-Williams and PPG in terms of their interest-bearing debt. Okay, 2 more quarters, if things don't work out, they might actually get into more debt. But obviously, if the price keeps going up and the debt keeps going lower, this number will keep going lower. If the price keeps going down and the debt level stays where it is or even higher, then we are in trouble. Okay, but as you can see, interest-bearing securities, absolutely no issues with any of these companies. So there you have it, 5 different companies. I'm going to show you the one I own, and that is, okay, so the 2 that I own is Air Product and Chemicals. So right now, as you can see, I have £3,855 in this company, 15 shares. Okay, I'm up 31, almost 31%, or £900 right now as we speak. I've been buying this company when it was really cheap, and then it gone up a little bit, and then I was focusing on more other companies. I wish I bought more, but hey, there you go. I didn't want this company to be, in fact, it grew a lot to the point now it's actually second biggest company in my portfolio. And it's not because I've been buying more, it's because it's just gone up so much in the last few months, right? The next company I wanted to show you is if I can find that, is PPG Industrial. There we go, that's it. Okay, up right now about $93 or almost 7%. I only own 13 shares, and like I said, I would love to add more of this company in the long run. So there you have it, 5 different companies in the material sector. What I will be doing is we'll be looking at the rest of the S&P 500 sectors, and I will share that with you inshallah in the next few weeks. And again, like I've always said to you guys, the most important thing is I'm kind of giving you an overview of what some of the data that I find on different websites. Then it's your responsibility to go away and do a little bit more research. This is good, it gives you an overview, but then what you need to do is go to the company website, read their latest earnings reports. Okay, go through every single sector or section of that business, try to understand what they sell, who's their customers, are these customers actually going to be around for a long time. Okay, you need to realistically look at these companies deep down before you put a penny into this company, because that's what I do. Okay, I've made mistakes early on when I was starting investing, buying all sorts of companies without actually doing my due diligence. Okay, and obviously, alhamdulillah, I haven't lost money, but some of these companies I had to sell them and afterwards because of the mistakes that I made early on. So it will be really important to make sure that you are looking at every single company that you're buying in terms of details, basically in terms of their financials, who's running this business, how long have they been around, and so on. Anyway, that's what I wanted to do today. I want to share with you this, inshallah. Please like the videos, it really genuinely helps. If you are still here, give the video a like. Let me know what companies you would like to look at as well. I posted a kind of quiz thing on the community section, so let me know what companies you would like me to analyze, and then I'll group them together, and then I'll look at it inshallah in the next few weeks. Have a wonderful day. Assalamu Alaikum.